What is business equipment financing? This is Samantha. I am a financial expert and help companies build their business credit. Like and share the video, subscribe the channel. Today we're gonna talk about business equipment financing. Business equipment finance refers to the leasing or renting of machinery, vehicles, or other equipment. This eliminates the requirement for capital equipment investment while yet allowing the company to operate successfully in a short period. If you manage a small business, you understand how important it is to get, upgrade, or replace the equipment you need to carry out your daily tasks quickly and affordably. Purchasing equipment altogether can put a significant strain on your cash flow, but equipment financing can be a fantastic way to keep your business running smoothly or even grow to meet increased demand. If you're wondering what business equipment financing is, you've come to the perfect spot. Let's talk about how does business equipment financing work. A loan used to acquire business-related equipment, such as a restaurant oven, automobile, or copy machine, is referred to as equipment finance. When you take out an equipment loan, you must make monthly payments that include both interest and principal over a certain period. The lender may request a lien on the equipment as collateral against your debt as security for the loan, similar to how an auto loan works. You own the equipment free and clear once the loan is paid in full. In addition, the lender may place a lien on some of your other business assets or seek a personal guarantee. If you fail to repay your loan, the lender may confiscate your company assets, and if you provide a personal guarantee, your assets as well. To understand your risk, you must carefully analyze the loan details. Since we already have an idea of how the process of business equipment financing is, let's find out what equipment leasing means and how it happens. Equipment leasing is when you pay the owner of the equipment a set amount of money each month in exchange for the use of the equipment for a set length of time. Unless you and the owner agree on renewal terms or a buyout, the equipment is returned to the owner at the conclusion of the lease period. Leasing requirements are often less severe than financing requirements. However, if the equipment is important to your business, the continuous payments on leased equipment without the option of future outright purchase may be a more expensive option. The type of business you run and the equipment you require are important variables in deciding whether to lease or buy. That's why equipment finance is useful for companies who are having difficulty obtaining financing since the equipment is used as security, and if they fail to make payments, the equipment can be taken away, as ownership rests in the hands of the financial institution or the leasing company. And when a lender makes an equipment-secured loan, the amount funded cannot exceed the collateral value. If you, the borrower, fail to make your payments, the cash value of the equipment will satisfy your obligations. Because no equipment is immune to depreciation, the loan does not exceed the economically usable life of the financed equipment. Advantages and disadvantages of equipment financing. Here's a quick rundown of the many aspects to consider if you're considering about financing company equipment. Advantages of equipment financing. Can assist you in establishing business credit. Can be a cost-effective alternative, especially if you choose a secured loan. Can help you receive the equipment you need for your firm to develop. Hello there. This is a simple but useful template to help you to communicate almost anything you want. Stay with me to see how it works. Are you in a need for business equipment financing? Equipment financing is widespread in companies that are unable to obtain traditional funding. It allows funding for the purchase of much-needed equipment for a new firm. This strategy is frequently less expensive than paying cash since payments may be stretched out over a predetermined length of time. Purchasing equipment outright can be costly and reduces liquidity. Thank you for watching this video and your likes and shares. Don't forget to subscribe the channel and leave the comment with ideas which else topics you're interested to watch. Thank you. See you, bye.